On behalf of Forbes Mazars and the ESOP team, I'd like to welcome everyone to today's webinar, Plan Sponsor ESOP Accounting Advanced Sponsor Topics. As you may be aware, on June 1st, we officially launched a new global professional services network, Forbes Mazars. The firm is ranked among the largest public accounting firms in the United States, with 7,000 dedicated team members who provide assurance, tax, and consulting services for clients in all 50 states and internationally through the global network. Let me introduce today's presenters, Angela Fisher and John Gernon. Angela's area of focus is employee stock ownership plans in privately held companies. She assists with the structuring and facilitation process of creating new ESOPs. Angela's experience with ESOPs also includes providing financing assistance, tax planning, record keeping, repurchase planning, employee communication, and structuring of executive incentive plans. John has more than 20 years of experience providing audit, accounting, and consulting services to a variety of clients. He works with a wide range of companies across the commercial and construction industries. He provides services to companies with complex corporate structures and accounting issues, many employee-owned, and meets with management, boards, and audit committees to discuss technical accounting issues. I will now turn it over to Angela.
Good morning, everyone, and again, welcome to today's webinar. And as Holly mentioned, my name is Angela Fisher. Today, we will be covering what I like to call the GAP ESOP Accounting 201 course. So the last webinar that we hosted a few weeks ago, it covered more of how to account for things like annual contributions to the ESOP, how to account for the loan payment and those required footnote disclosures. But really, what we're going to talk today is about sort of that, kind of 201 more advanced topics. But if you weren't able to join us a few weeks ago for that webinar, or maybe you would like a refresher, there will be a link on the archived version, or we're happy to send you a link to that after this webinar. But like I said, today we're going to cover those other items generally found in ESOP transactions. So other items, meaning things like warrants and management incentive, synthetic equity plans that generally accompany ESOP transactions that have closed really over the last 10 years. And so I have the pleasure of spending a good amount of time working with new ESOP transactions. And each time we close these transactions, I always have a CFO or a controller say to me, I really hope you can help me account for these things. And so that's what we're here to do today. And as we move through the presentation, it is important to remember first that each transaction is going to be different, and each warrant agreement, each SAR plan document is going to be written differently. And so we'll just kind of talk about what I generally see of how these documents are written for either the transactions that we help facilitate or the transactions that our other attest and tax clients complete. So it's important to understand to consult your accountant and to review the documents to determine the proper accounting treatment. And then at the last, we're also going to talk about push-down accounting, which I think we're getting more and more questions about. As we discussed kind of on the last webinar, it's important to remember, right, that your balance sheet is going to look different after you do a leveraged ESOP transaction, particularly a majority one. And so we're going to discuss the pros and cons of push-down accounting and what to think about as you determine whether to do push-down accounting or not. Now, for today's purposes, I am going to help explain the concepts of the different synthetic equity, the whys and the hows and what they're used for in ESOP transactions, and then I'm going to turn it over to John to explain in more detail kind of the accounting behind those. So let's start off with understanding warrants. What is a warrant? Why are warrants used? How do they work? So a warrant, by its very nature, is a financial instrument. It allows the holder, and in an ESOP transaction situation, it would be the selling shareholder, to purchase shares of the company at a specified price at a specified period of time. And in terms of an ESOP transaction, warrants are used in conjunction with seller notes. So now some ESOP transactions are structured with a substantial redemption followed by an ESOP purchase. And generally the warrants are going to be tied to those redemption notes. So at its heart, warrants in an ESOP transaction allows the seller notes or that note holder to purchase shares of the company at a future period of time for a stated rate. Why are warrants used in ESOP transactions? And this is a very good question. In simple terms, a warrant is part of the financing package. It is when a seller is selling particularly 100% of the outstanding stock to the ESOP. That equates to putting, 100% of leverage or debt on the company books. So let's say if I own a $10 million company and I decide to sell 100% of the company to the ESOP, I can't go to a bank and expect them to give me $10 million of funds. No third-party lender is going to give you 100% of the value of the company. They're just not going to. So instead, a large portion of an ESOP transaction, particularly if you go 0 to 100%, is going to be financed by the seller themselves. And they are going to take back seller notes. They're financing a piece of that transaction themselves. Now, these seller notes are going to be subordinated to a bank. If you're in the construction space, they're going to be subordinated to the bonding company as well. And instead of being an owner, so like right now, if you hold your shares, then you're an owner of the company. But whenever you sell 100% to an ESOP, now you're essentially shifting from being an owner to being a creditor of the company. So these warrants are used in ESOP transactions really to compensate the holder or the selling shareholder for taking back subordinated seller notes. If you think about it, it's riskier debt because it's subordinated, and the sellers are further down the line in terms of repayment. So if you borrow money from a bank, then that bank wants to achieve a certain market rate of return on that note. And the same is true for a seller that is taking back a substantial note. So the question arises of, well, what's market rate? And a market rate of return could be different in an ESOP transaction compared to a normal public market. So these seller notes, again, they're going to be subordinated, meaning they're more risk because they're the last ones getting paid on the totem pole. So because they're more risk, they should garner a higher market rate of return because of this riskiness. So one way to achieve the higher market rate of return is to charge a higher interest rate that gets paid with each payment. But naturally, if the notes pay a higher interest rate, then it means the company has to come up with more cash in order to fund those payments. And that can put a strain on the company cash flow by having to pay a higher interest rate. This, coupled with the fact that interest income to the seller is taxed at ordinary income tax, which under today's current tax law is 37% for federal plus the 3.8% net tax. So as I go through the presentation, I'm also going to talk some about tax reasons of why you may see warrants over higher interest and tax implications of the synthetic equity as well. So that way you can kind of understand both the GAAP side of it, but then also from a tax means what is more advantageous. So by just paying interest, then the company's having to pay more cash and the seller is having to pay ordinary income tax, which we know are at higher rates under today's current tax law. So by using warrants in the financing package, it is allowing the company to pay down that interest rate to a more manageable rate, right? So the lower the interest rate, the lower the amount of cash that the company has to come up with to pay back that seller debt. But what happens is, so the company is making those principal payments and interest payments at that lower rate. And then the warrants will come in on the back end whenever the seller debt has been fully repaid to bring that rate of return up to a more market rate. And what happens is that these warrants are put in place immediately after the transaction whenever that value is low. So because, let's say I have that $10 million company and I put $10 million of debt on the books, well, the value isn't zero, but it is very, very low. And the strike price of the warrants is going to be that low price. And then as time progresses, assuming the company is a 100% S Corp ESOP, then the company is using those tax-free earnings to pay down the debt of the company. And so if you're paying down the debt of the company, then the value should be appreciating as long as it's still, paying down debt with those tax savings. So over time, the appreciation is accumulating for those warrants as well. And then when the debt has been fully repaid, the warrants will either be called by the company or they're going to be put back by the holder, and that holder is going to receive appreciation in value from whatever the most recent value is less that original strike price. Now, most warrant agreements are written to contain language that does not allow the holder to actually retain legal title to the shares. Instead, they just get the appreciation. So this appreciation the holder is getting would get long-term capital gain treatment, which under today's current tax law is at 20% for federal, a high of 20%. So even though the transaction purchase price is negotiated at the front end of the deal, right? Warrants are used to pay down the annual interest rate, allow the holder or the seller to retain upside in the future appreciation of the company, but then also shift a portion of the rate of return from ordinary rates to long-term capital gain. Now, you're probably thinking, oh my gosh, these warrants are complex, and they are complex. So it's important that if you are considering an ESOP transaction and you want to use warrants, not all of my sellers use warrants. Some of them would rather just pay themselves a higher interest rate because they know it's more fixed than what the warrants would be. Challenge you if you are thinking about an ESOP transaction, making sure that you are engaging qualified advisors to write those warrant agreements so that they don't violate any sort of S Corp rules. Because it's important to note that warrants do require up OID or original issue discount each year while the warrants are outstanding. So again, these are complex. You need to consult your tax advisor. You need to consult your ESOP advisors if you are thinking about doing an ESOP transaction. And now I'm going to turn it over to John. Well, actually, first let's do a polling question. Of warrants are generally awarded to employees of ESOP companies, management of ESOP companies, selling shareholders, or none of the above. And here in a little bit, after John discusses the accounting for warrants, we are going to talk about, well, what sort of management incentive plans can I put in place for my management team? How do I keep them incentivized to continue to grow the company and provide them a market rate of compensation as well? And then, of course, if you are thinking about doing an ESOP transaction, making sure that in that feasibility analysis, you are looking at what sort of benefit levels are you providing to employees of ESOP companies. So I'll give you guys a few seconds to complete the polling question. And the answer is warrants are generally awarded to selling shareholders. Now, it is maybe important to note with an ESOP, those sellers can continue to work for the company. And so, in a sense, maybe you can say that employees of ESOP companies are also selling shareholders. And then they could also still be in the management team. But warrants are generally awarded to selling shareholders. And now I'm going to turn it over to John.
Thanks, Angela. We'll start kind of diving into the accounting for the warrants. The first point there in blue is kind of the crux of this portion of the presentation. The warrants are going to add complexity to your financial statements, and we're going to kind of talk through a lot of those items, and you should be able to explain to the users of your financial statements what the impact the warrants have had to your financial statements. There's really two items to consider when you're looking at your warrant agreement. The first one is, how do you value it? What value do I report it at? And the second item is, where does it go on the balance sheet? So once I know the value, where does it go? Where does it get presented at on the balance sheet? A warrant has characteristics of both equity, right? It's a promise to issue shares, and then also it's an obligation that's going to be settled in the future. So it kind of sounds like a liability. And so trying to distinguish which that is, and the guidance can be found and ASC 470-20, debt with conversion and other options, and ASC 480-10, distinguishing liabilities from equity. So, determining the value, warrants must be recorded at fair value on the grant date. So, there are several ways you can do that. The most common way is to use a Black-Scholes option pricing model. There are other models that you can use, but Black-Scholes is generally the easiest. It's readily available. After you determine the value using an option pricing model, which we'll walk through, the proceeds of the debt instrument, the proceeds of that seller note must be allocated to the debt and to the warrants on the relative fair values at the date of issuance. What happens is that usually results in the debt being recorded at a discount, and we'll kind of walk through what that looks like. So again, back to how do you determine the value of the warrant? You will, using a Black-Scholes option pricing model, there are several inputs you need for the calculation. The first is the underlying value of the stock of the company. For ESOP companies, that's generally a fairly easy exercise because you are required to get a valuation annually. So you will use the value that is in your annual ESOP valuation. The other input is the exercise or strike price, the price in the agreement that the selling shareholders are able to purchase the stock for. Then you need to know the expected life that will be stated in the warrant agreement. And it's reasonable when you're going through the calculation to assume that the warrant holders will hold that warrant until the end of its life. So just use the entire life. The risk-free rate in theory is the rate that an investor would expect from a risk-free investment. So generally when we're helping clients, we use U.S. Treasury bills. So if you've got a 5-year warrant, go and find the rate on a 5-year Treasury bill at the date of the warrant transaction and use that rate. And then finally, the model does require some volatility, which is really the movement in the stock price. For non-public companies, you are allowed to use volatility of an industry sector, and you can go out and find that information on the web. I will say that if you're having trouble finding volatility, generally I have found it doesn't have a ton of impact to the value. So you may be able to just run some sensitivity analysis and say, hey, if we put 15% in here at volatility, it's X. If we use 60% volatility, the value is Y, and there's really not much difference there. So I mean, I wouldn't worry too much about the volatility, but you should be able to find that online. Okay, so now we've determined the value. So now we have to decide where does this go on the balance sheet. So the guidance requires liability treatment if both of the following characteristics are met. One, it embodies an obligation to repurchase equity shares. That's generally going to be yes. And then the second, and you have to meet both, is it requires or may require the issuer, the company, to settle the obligations by transferring cash. So careful consideration of the terms in the warrant agreement is necessary. As Angela mentioned, generally in the ESOP transaction, there is a put option in the warrant where the holders of the warrant can put the warrant back to the company for cash. This will generally require liability treatment. You may also see call options. Some warrant agreements have a call option where the company can call the warrant back for cash as well. Either one of those clauses is going to require liability treatment. So, and as Angela mentioned, most of those, or the reason that you're going to find a put or a call option is because the intent is never for the warrant holder to actually own shares, right? You don't want anybody owning shares other than the ESOP trust. Otherwise, you're no longer going to be 100% ESOP. So if you're an ESOP and you've issued warrants, likely you're going to be at liability treatment. So if you've read through your agreement, you found a put or a call option, you've landed on liability treatment. Now, what's next? So the warrants need to be recorded at fair value. So let's assume that you've done your Black-Scholes and you determine that the fair value of the warrants are $500,000. How do you record this? Well, in that case, you would credit a warrant liability for $500,000, and then the other side of that, you got to find a debit is debt discount, a discount on your debt. So that is a contra debt account, and the debt discount is then amortized off over the life of the seller note, which increases your interest expense. The other key point with liability treatment is the value of the warrants must be remeasured at each reporting date. So annually, if you're doing annual financial statements annually, you must remeasure that liability for the warrant and adjust your value. So just quickly, even though most warrants and ESOP transactions will not get equity treatment, I just wanted to walk through if you don't have a put or a call options and the warrant can only be settled in shares, and you are going to get equity treatment. Equity treatment is kind of considered preferable because you record the value of the warrants at grant date and you don't ever have to remeasure it. So again, the credit the entry would go down into equity and would not need to be remeasured. So if we want to just kind of walk through a sample transactions to kind of just pull all this together, let's assume we've done an ESOP transaction, and part of that transaction we have a $10 million seller note with detachable warrant, 20,000 detachable warrants. The seller note is amortized over a 10-year period with let's assume a 3.5% interest rate. We can all remember when that was a market rate. And if you ran an amortization schedule, you would see that the annual payments would be $1,202,414. All right, so then we'll use an option pricing model, and based on our value of the stock, we've determined that the warrants have a fair value of $400,000. The term of the warrants have a put option, so we know they are a liability. So let's take a look at that journal entry. So again, we determined 400,000. So the credit goes to warrant obligation, warrant liability for 400,000, and then there's the no payable discount for 400,000. Oh, and that gets us to a polling question. Put options generally require a warrant to be presented as equity on the balance sheet, presented as a liability on the balance sheet. C, warrants don't need to be recorded at all, or D, none of the above. B is the correct answer. Put options, right, are going to require cash. The company to issue cash, and that requires liability treatment. So, can I make sure I didn't skip on? Okay. So now we can kind of talk about the annual recurring entries that if you have warrants and they've gotten liability treatment, kind of what do those entries look like? So you have your typical entry for the annual ESOP contribution and loan payment. This releases the shares and generates compensation expense, which was covered in the first webinar. You're going to make your payment on the seller notes like you would for any other piece of debt and record that. You will need to amortize the discount on the note payable, so you'll need to create an amortization schedule for that. And then finally, part of the liability treatment is determining the value of the warrants at each reporting period and adjusting that liability at each reporting period each year end. So some things to consider, again, is creating a new amortization schedule for the debt discount. that amortization schedule should be done on the effective interest method. It's generally not materially different than just doing a straight line. And again, that's going to increase short interest expense. The theory there to interest expense is really that was the warrants were enticing the seller to accept those notes, so it gets reported as interest expense. And then again, the warrant liability is revalued, remeasured every year, and that liability is updated, and the change runs through the income statement, which creates obviously some volatility in your financial statements at year end. And so you need to make sure the users of financial statements understand the accounting treatment and understand that there is going to be an adjustment late after you received your ESOP valuation to adjust your warrants, and that can swing your income up or down. Again, so here's kind of a look at the journal entry. So we've got our payment on the seller note. So you debit note payable for the principal portion, obviously, and debit interest expense for the interest piece. And then you're going to amortize down and credit your debt discount, the contra liability account. So that is a credit account for 64,186. That is where you will see, if you remember, we had a $10 million note. And so that 64,000 is not a straight line interest, that's effective interest. And that amount gets added into the interest expense. So the 852, 414 and the 414,000 of interest expense doesn't equal the cash going out, because it also includes the debt discount, the other side of that $64,186 entry. So that is the entry. Then let's say you're a year later, and now you've done your valuation, and the warrants have a value of $550,000. So you've got to increase your warrant obligation, the liability. That's the credit for $150,000, and the other side of that is expense, warrant expense of $150,000. So now we can just kind of talk about footnote disclosures. There are required disclosures when you have warrants in your financial statements. First, you must provide a description of the warrants, including the number outstanding, exercise price, and the term of the warrants. You must disclose your method of determining the fair value. For example, what kind of option pricing model you use. If you use Black-Scholes, you are required to disclose the inputs that you used in that model, so the risk-free rate, the volatility, all of that information that we went over previously. And then obviously, you are required to disclose the value of the warrants at the end of the year. So now I'm going to kick it back to Angela to kind of introduce our next topic.
So we just discussed the part of the financing of an ESOP transaction. And so separate from warrants is a management incentive plan. And that plan can be in the form of either stock appreciation rights, or SARs for short, incentive stock options, which are ISOs, or even phantom shares. So in a majority ESOP transaction, it is not uncommon for there to be an implementation of a SARs plan or an ISO plan. And these plans are really meant to attract, retain, and motivate your management team. So I like to call these the golden handcuffs to retain your management team. During an ESOP transaction, one of the negotiation points on that term sheet that you're negotiating with that trustee, it is going to be a percentage pool of fully diluted shares of either ISOs or SARs. And those ISOs and SARs, they're going to be very similar in a lot of ways, but then they are different in other ways. So I'm going to walk us through really what the difference is between a SAR and an ISO to help you better understand maybe what you have in your management incentive plan. So I'm going to start with ISOs, because we like ISOs whenever we do new ESOP transactions. And in a new majority ESOP transaction, right, that value is going to be severely depressed, because right after the transaction, you've just leveraged up the company. You put debt on the company books. So ISOs are going to be granted, or a piece of the ISO pool is going to be granted right after the transaction whenever that value is low. And the IRS states that in order for an ISO to be a qualified incentive stock option, then a maximum of $100,000 may become vested each year per ISO holder. And this low strike price generally allows that incentive stock option to fall below that $100,000 max ISO pool after closing at that low strike price. Then each year, as the company is paying down that debt with those tax-free dollars, then the value of the company is appreciating, very similar to a warrant. However, ISOs are going to be subject to a vesting schedule, whereas warrants are not subject to a vesting schedule. That vesting schedule can be based on time, or it can be based on performance, or maybe a combination of both. So lately in new transactions, we've seen more and more trustees negotiate for a combination. Maybe half of the ISOs are time-based and vest over 10 years, whereas the remaining half are performance-based and vest if certain EBITDA targets are met. And then once those ISOs vest, then the holder can exercise their options. With an ISO, they have two alternatives. One is to exercise the options for shares and immediately put the shares back to the company. This is considered a disqualified disposition, and the appreciation between the strike price and the most recent value gets included as ordinary income on the W-2, and then the holder is going to pay ordinary income tax on that appreciation. And it's a very simple method that we see. But there is a second option for ISOs, and that second option is to exercise the options for actual shares. So the idea is to hold the real shares for 1 year and 1 day, so that when the company buys those shares back at the end of the period, the appreciation is taxed at long-term capital gain treatment, which we know is at more favorable rates. So there are a few things to consider when deciding whether to do the first option or the second option. One is that under the second option, the holder does have to come up with the exercise price for those shares. I've seen it written to where it's in either cash or maybe a note payable. And then also, during that 1 year and 1 day, they're a real life shareholder, and they will receive a K-1 for their portion of the income, and they will have to pay taxes on it. So before, they may have gotten a distribution to pay their taxes, but under an ESOP, generally that holder is not going to receive a distribution, because if they received a distribution, then the ESOP would have to receive their pro rata piece as well. And so all of this cash is going out of the company, and depending on timing, there's ways to alleviate this. And then there's also AMT issues to consider if you decide to hold your shares for a year and a day. So ISOs are complex, whereas SARs are generally much simpler, where once the SAR is granted, whatever the most recent share price is going to be the strike price. And then over time, the SARs are going to vest and ultimately get exercised and paid out, and it's going to go on the W-2 as ordinary income. So it's important to understand for the company, for the management team, to understand how these work and whether you have SARs or ISOs, particularly whenever they start to come due. And also remembering that the trustee wants to make sure that these SARs or ISOs are reasonable compensation to that management team, because the synthetic equity is ultimately diluting the value of the company by having that incentive out there. And so they want to make sure that it is reasonable. And now I'm going to turn it over to John to discuss more of the accounting.
Thanks. Yeah, so now let's talk about the accounting for stock appreciation rights and stock options. The same analysis that we went through with warrants really applies to these instruments as well. You've got to determine the value, and then you've got to determine whether these are liability instruments or equity. So let's start with stock options. Just like with the warrants, we typically see a put or a call option in the stock options in conjunction with ESOP transactions for the same reasons. You don't want new shareholders. The ISOs grants the holder the option to purchase a share at a set price for a period of time. If that holder of the warrant can exercise and receive cash instead of shares, something net cash settled, then you'll get to liability treatment. If the holder can only receive units, then you're going to get to equity treatment, but that would be unusual in an ESOP situation. In either case, the company will record compensation equal to the fair value of the award recognized over the vesting period. So if you've got a 5-year vesting period, you're going to take the value and divide that evenly over the 5 years. If the ISOs are equity awards, the credit will go to additional paid-in capital. If they are determined to be liability awards, then that credit is obviously going to a liability account. And then again, the company is required to use an option pricing model like Black-Scholes to determine the value. Now, stock appreciation rights, as Angela mentioned, they only grant holder the rights in the appreciation and the value of the share, not the underlying share. So this will cause SARs to always receive liability treatment. So if it's a stock appreciation rights, that first analysis is kind of off the table, and you know you're into liability treatment. Now, one item to mention here for non-public companies, if you have a liability award, so either a stock option that gets liability treatment or a SARs, you are allowed to make an election to use the intrinsic value instead of fair value. The intrinsic value is the difference between the strike price and the current stock price and doesn't require the option pricing model. And then that intrinsic value is measured each year end and recorded as a liability with the corresponding debit to compensation expense. And we'll kind of walk through that. This, we kind of included this grid here. It's kind of a good summary of the various type of instruments that you can have. In the first 2 columns there are equity treatment, and then the last are liability treatment, and then various types of awards are there across the top. And you can see that the GAAP expense is there, and that's an important item. So for equity treatment, there you get it's measured at grant date, and then you forget it, and then obviously if it's liability treatment, we discussed that those have to be remeasured each year. There's additional information about the tax recognition, employee taxable income, a lot of valuable information kind of on that chart that you're welcome to take a snapshot of, or it'll be in the materials. But I think the main takeaway is when do you record the expense and how are you required to calculate it? Polling question. Stock appreciation rights must be recorded at A, fair value, B, intrinsic value, C, fair value unless the company is non-public and elects to use the intrinsic value, or D, it's not required to be recorded. And it was a bit of a trick question. The fair value is technically a correct answer. They are recorded at fair value. And then C is technically the correct answer, fair value, unless the company is non-public and elects the intrinsic value. So kind of a tricky one there. Okay, so here we can kind of just walk through an example of what a typical stock appreciation transaction might look like. Let's assume there were 5,000 SARs issued to key employees. The agreements state that the employees will receive the right to the appreciation in the stock value over $4.50 a unit, which was the initial ESOP value. The SARs vest equally over 4 years. At the end of the year, the company received its annual valuation and determined that the value of the stock was $5 a unit. That's the value of the underlying company stock. So assuming the company is a non-public company and have made an election to use the intrinsic value, you would take the $4.50 strike price from the $5 fair value. You would get then a 50 cents intrinsic value. So each SARs is worth 50 cents. You apply that to the 5,000 SARs, and that would equate to $2,500 of expense to be recognized over a 4-year vesting period. So that's the $625. The $2,500 divided by 4 years is $625. So you would record $625 liability and then SAR compensation expense. On the flip side, if you were using fair value, you would take the $5 underlying share price. You would run that through Black-Scholes in this analysis. We then said the fair value of the SAR unit is $6. It's not going to be that far off, but for purposes of example, let's assume we ran our Black-Scholes analysis and we realized that the fair value was $6. You take that $6 again times the 5,000 SARs outstanding, and you get 30,000, and you divide that by the 4-year vesting period to record annually, and you would be at $7,500. Realistically, they're not going to be that far apart. So the advantage, if you're non-public, of electing the intrinsic value is obviously not having to use an option pricing model and obtaining those other inputs, just simply taking the intrinsic value, the difference between your strike price and the current stock price, and multiplying that out over the number of SARs outstanding. So again, we've got footnote disclosures. For SARs, you're going to have to describe kind of basically the SARs plan, including the vesting period. You're going to, again, describe your method of determining fair value, or if you elected the intrinsic value, any inputs, if you're using Black-Scholes, again, any inputs to fair value. And then generally in tabular format, you're going to have the number of SARs granted, exercised, forfeited, and outstanding at year end. So that kind of gets us through SARs, and this is the kind of an introduction to the next topic, push down accounting. It's a pretty meaty topic, and we want to spend a few minutes just kind of introducing it. It could be a strategy to help reduce the equity deficit created in most ESOP transactions. Now, if your transaction's already complete, the horse has kind of left the barn on this. So this is really, if you are thinking about an ESOP transaction, push down accounting is something that you may want to consider to help kind of reduce the deficit that can be created. So as you know, the deficit in equity is created when you record the company's inside loan to the ESOP trust. This receivable from the ESOP trust is required to be shown. The debit, instead of shown as a receivable, is down in equity, a contra equity account called unearned ESOP shares. And that unearned ESOP shares can oftentimes be greater than the company's total equity, then causing the financial statements to show a negative equity or a deficit position in equity. And depending on the users of your financial statements, that may cause the questions or concerns. And push down accounting can help alleviate that. If elected, push down accounting will require the employer to prepare financial statements under a new basis of accounting, Topic 805, which is essentially purchase accounting. If you've been through a business combination, it's the same accounting. So how do you determine if you qualify? You must determine if there was a change of control as a result of the ESOP transaction. This assessment is based on the specific facts and circumstances of your transaction, and will take careful consideration. And it's a fairly judgmental topic. So some items that you need to consider are, is the operating company a VIE or voting interest under Topic 810? How are the governing documents designed? What did the board look like before the transaction? What does it look like after the transaction? And really, that's a really important one is, your shares are now owned by an ESOP trust. The trust doesn't make business decisions. So the guidance kind of really points out is, who has the substantive participating rights, who's really making decisions, who's setting the compensation of management, who's making operating and capital decisions for the company. And if those changed as a result of the ESOP transaction, then you could argue that you had a change of control and elect push down accounting. So let's assume that you do believe you have a change of control. You've elected push down accounting. You must record all assets and liabilities at the ESOP transaction date at fair value. This obviously can be a kind of a difficult exercise. You may be required to go get valuations of real estate, equipment. Every asset, including inventory, must be recorded at fair value, and so it's more complicated to get that initial ESOP transaction recorded. You're going to need to identify intangibles, any trade names, trademarks, patents, and then finally goodwill would be recorded for any difference between the purchase price of the ESOP purchase price and the fair value of the assets. Generally, the fair value are greater than your carrying value, so you get a write-up on your balance sheet, and that write-up creates goodwill, and the other side of that entry, the credit would go to equity, which helps offset the debit that's sitting there with the unearned ESOP shares, and so it can either alleviate that unearned ESOP shares and get you back into a credit position, or at least minimize it. That is generally why the people are trying to get to push down accounting. So here are the kind of the pros and the cons. Again, the pros, right? You've got a more positive equity position depending on the user of your financial statements. That could be a big deal. You've got your write-up of your assets and liabilities, so you get probably to puff up your balance sheet a little bit. And then on the cons side, you're going to create additional depreciation and amortization due to that write-up and the creation of intangibles. So net income is a metric, an important metric for the users of your financial statements. You're going to have to make sure they understand the additional depreciation and amortization. Again, it's going to create just additional complexity in recording the transaction with the valuations that may be required and the additional accounting. So again, just something to be aware of, especially if you're still in the process of designing your ESOP. If it's something that you want to make sure you avoid, you know that you don't want to go down that road, Angela can spend a few minutes on kind of the ways to design your ESOP so that you avoid that situation.
Yeah, and I think what John said about, considering whether you want to do purchase accounting or not should be discussed during the transaction and not after the transaction. And it's important to understand who the end users are of your financial statements. So as someone that works a lot on new ESOP transactions, making sure that the company and your advisors are communicating with your bank, or if you're in the construction space, making sure that you're communicating with your bonding company, because again, as we talked about last webinar, if you're going from 0 to 100% ESOP transaction and you put that unearned ESOP shares on your equity section, a lot of times it creates a deficit. And if your bank and your bonding company don't know that this is going to occur, then it can cause some headaches. And so what we always highly suggest is educating the end users of your financial statements of what an ESOP or what the company financials are going to look like post ESOP if purchase accounting is not done. And a lot of banks, some of the bigger banks, they have ESOP specialty groups that have educated their credit departments, and so they are aware of that, and they don't necessarily require push down accounting. Same thing with bonding companies, but if you get maybe more localized banks that don't have the ESOP expertise, then that could be when they want to see purchase accounting. But what, as John alluded to, one way that we have found helps is if the company decides to form a holding company and have that holding company own all of the shares that ultimately get sold to the ESOP. And in that situation, then the debt of the transaction could be put at the holding company books. And then whenever financial statements are provided to other users, it could be at the operating company level. And so how that kind of shakes out is definitely whenever you're writing those debt agreements, understanding how GAAP treats guaranteeing debt versus being a co-borrower, because that could also affect if you have to push the debt down to that operating company. And so making sure that you're talking with to understand how those loan agreements should work. But a lot of times we see this holding company be put in place up at the top, the debt there that doesn't provide financial statements. A lot of times to governmental agencies that don't understand GAAP ESOP accounting, then this is a good way to keep that positive equity position, but then still have the ESOP transaction. So we're seeing a lot more holding companies being formed. But again, speaking with your banks and your bonding companies, who are the ultimate end users about this transaction ahead of time, is going to definitely help you in the long run. And so I think we can move on to just the last polling question, which is more just a question for you guys of, would you like to schedule time to discuss a topic with us at a future date? So it could be accounting for warrants, it could be accounting for management incentive plans, push down accounting, or maybe you don't have any questions currently and you're just looking for some CPE, which we all need. So just go ahead and just choose a response and we will reach out to you. And so I think Holly had a few questions come in. Holly, if you want to maybe list out the first question.
Sure. And if you did submit a question that we don't address during today's webinar, we will follow up with you via email. But we do have a question here. Do all ESOP transactions have warrants? And how would I know if the ESOP at my company has warrants?
So that is a good question. Not all ESOP transactions contain warrants. So some of my sellers say, I don't like how warrants are tied to appreciation of the stock because it's riskier, right? Because it relies on the company performing to get that appreciation. And so sometimes I have sellers that say, I would rather just have a higher fixed interest rate and maybe it takes longer to repay, and I'm perfectly fine with that. And so not all ESOP transactions have warrants. If you are selling a minority interest to an ESOP, then a lot of times warrants will not be tied to it because you could probably get enough outside financing to finance that minority piece. But I think where you can tell if your ESOP transaction or if your company's ESOP transaction has warrants is by getting a copy of what's called an ESOP closing binder. And that binder is going to be, hundreds of pages. It's going to be a big PDF, but a lot of times those attorneys are great and they put bookmarks on that PDF. And in it is going to have things like warrant agreements. And each seller that has warrants would have its own warrant agreement. So that's one way to tell if your ESOP has warrants associated with that transaction. And then in that closing binder, you can also read what's called like a stock purchase agreement to tell whether the transaction also has SARs or ISOs as part of the management incentive plan as well.
Okay, great. We do have another question. Do warrants have a vested schedule like SARs?
So warrants are not tied to a vesting schedule generally. So SARs, remember, are tied to executive compensation, and so it does generally have a vesting schedule. So SARs, I would say generally we see vesting anywhere between 3 to 5 years. Some of it being time-based, right, like I mentioned, but then also having a portion being vested based off of if EBITDA targets are met. Generally, those EBITDA targets are set in the transaction phase because it's part of that negotiation, whereas warrants are more tied to the financing package, right? And so it's about how do we reward the sellers for taking a lower rate of interest? How do we bring their rate of return more up to a market rate? And so generally those warrants are not going to be subject to a vesting schedule, whereas you may see the SARs and the ISOs be subject to vesting. And then I think there's time for one more question, Holly.
Okay. Is there a limit in value or amount that can be loan versus warrant?
maybe let me kind of back up. So whenever a transaction is being negotiated, you're negotiating many different facets on that term sheet. So one of them is going to be a purchase price, and so that's going to be your loan amount. And that purchase price is going to basically say, this is how much the trustee is going to buy the company for. This is what we think it's worth. And then as part of the financing, the trustee and the sellers are also going to negotiate the interest rate. So that's going to be another point of negotiation. And then lastly, they're also going to negotiate the amount of warrants that are going to be tied to the transaction. And so it's important to understand that all of these kind of tie in together. So they're negotiated together, but they're very distinct items. So a lot of times if a seller wants maybe a higher purchase price, well, then they would have to take a lower rate of return on maybe the interest piece or the warrants, because they're getting that total rate, or the total package of the financing is higher because you got a higher purchase price. Or some sellers are saying, well, I'll take a lower purchase price if I can get a higher interest rate or more warrants. And so they're negotiated separately, but it's all about what is the company worth and what is a trustee willing to pay for the company based off of the cash flow stream of the company. So if there's any other questions about that, I'm happy to schedule a call. But I think we are at time now. If Holly, you want to wrap it up?
Yes, and just want to say on behalf of Forbes Mazars, thank you for attending today's webinar, and hope you'll join us for future webinars.
Thanks, everybody.